we are going to discuss on Introduction to Accounting. The accounting is the language of business. It is a standard set of rules for measuring a firm's financial performance. Accounting is required in almost all activities and all operations which require money. Assessing a company's financial performance is important for various groups. It could be customers, it could be lenders, it could be bankers, government, or it could be suppliers, general public, society. Everybody is connected with the accounting. Now let us understand what are the objectives of accounting. To keep the systematic records. This is one of the very important objectives of accounting, because all of us are doing business and this business records has to be systematically kept. The result is the performance of the company, which you can see through financial statements, that is profit and loss account and balance sheet. Accounting also gives you information about liquidity, how the money has come in and how it is spent over a period of time. One of the important objectives of accounting is protect your business properties, assets such as land, building, machinery. All these investments which you are doing over a period of time has to be protected. Accounting facilitates a rational decision making. What exactly you mean by rational decision making? It talks about think whether it is right and wrong and take a right decision. Accounting satisfies the compliance of laws, whether it is Income Tax Act, Companies Act, or SEBI rules and guidelines, stock exchange operations. So accounting covers all these following of rules and regulations. Why accounting is so important? Because you are required to take decisions at every moment of time, and whatever money is saved, that money you are expected to save for future expansion of the business. What are the functions of accounting? The first and foremost, keeping the records, and managerial function, how management should function, because accounting gives the basic information to which you can work on. Accounting also takes care of legal requirements, Companies Act, SEBI guidelines, stock exchange operations, and RBI rules and regulations, banking rules and regulations. Accounting understands your language of business, because all transactions are translated into the language which you know, so that you can understand and go ahead with your future planning. What are the advantages of accounting? It helps in having complete record of business transactions, whether it is a small amount or big amount. It provides useful information from taking important decisions which are connected with economy, which connected with the proprietorship, which connected with your resource utilization. It facilitates comparative study of current year's profits, sales, expenses. It provides user with factual and interpretive information about transactions. It helps in complying with certain legal formalities which are mandatory. Now, what are the limitations of accounting? Friends, accounting should be understood not only in terms of the advantages, but also you have to see the other side of it, because you should know how to overcome such limitations. So accounting is historical in nature. What exactly you mean by historical? For example, if you buy a set 20 years before, that cost 20 years before will be recorded in the books of accounts. So that is called historical. Accounting is limited to monetary transactions only. As I said before, only those transactions where monetary implications are there, only those can be understood in accounting. For example, if you are giving some donation to your friend, or you give compliment to your friend on his birthday, such transactions will not be recorded by your friend, because he is not required to pay money for that. So accounting statements do not always present comparable data, because if you compare wrong things, for example, if you compare apple with orange, then it is a wrong comparison. So accounting has to be used in a proper spirit. Cost concept is found in accounting. For example, price changes are not considered because cost is incurred at every step, and such a cost has to be captured at every step. Money value is bound to change from time to time. So accounting statements do not show the impact of inflation because that is not meant by accounting. Accounting records factual things. What has happened today, what you have spent, what you have received, only that will be coming. And inflation is an external factor which is not considered by accounting. The accounting statements do not reflect those increase in net assets value because the net asset value increase are connected with market conditions which is not reflected in accounting. Now friends, let us understand what are the principles and concepts of the accounting. As we know, when I am practicing as a doctor, I have to follow certain rules and regulations. Similarly, if I am a lawyer, I am required to follow certain basic rules. Similarly, accountant also required to follow certain basic rules because it is expected that you are a caretaker of the company and you are bound to follow certain rules and regulations when you do accounting. Let us try to see what are those. First is money measurement concept. As I said before, only those transactions which can be understood in terms of money are recorded by accounting. Secondly, business entity concept. We have to understand accounting for Mr. X and XYZ and company because both are separate entities by themselves. Mr. X is a separate person, even though he may be proprietor in XYZ and company, they are different in terms of accounting. Tomorrow, Mr. X can sell or purchase from XYZ and company, though it looks both are same. Going concern concept is the next concept where we always presume the business is going to continue for a long period of time because we do the business for making profits and we don't have intention to close the business at any moment of time. So going concern is continuous nature of the business. Next, cost concept. Cost concept assumes that at every transaction you incur cost and that has to be captured in accounting because without cost no accounting can take place. Next, dual aspect concept. Accounting believes for every transaction whether you receive or you pay has to be recorded, and there are two implications for every transactions which is called in technical terms debit and credit. For every debit there has to be corresponding credit and for every credit there has to be corresponding debit. That is why the assets has to be matched with liabilities. Next is accounting period concept where accounting believes accounts has to be closed at the end of accounting period. It may be 12 months or it can be 18 months also. Why we do this? Because you have to understand we should know whether you are in profits or losses at the end of accounting period. And if you don't do that, if you continue business for a long period of time without having accounting period, then how do we know whether we are making profitable business or no? Next concept is a conservatism. Accountant is supposed to be conservative because he is custodian of money. He has to take care of the money to the fullest extent as if he is a trustee, he is a caretaker. So he has to be conservative. Next is realization concept where accounting believes whenever money in your pocket, you are realized it. For example, if you get a check, that is not called realize because you have just received a check and you have not got the credit. Normally you get a credit on third day. So it says whenever you get the credit, that is called realize. Further going, matching concept where accounting believes revenues has to match with the expenses. because every income has to have expenditure and every expenditure has to match with the income. Without income, you cannot do expenditure, and that is why matching concept is very important. Next is consistency. Accountant has to be consistent in his treatment of accounts. For example, if you are valuing the stock, you have to value at cost or market value, which was less. And if you do that, next year also you should be following same principle. Otherwise, your profit and loss account will show different picture. Other example, you can think of depreciation. In 1 year, you may depreciate the assets at written down value. In another year, you can depreciate the asset at straight line method. In that case, both this treatment of depreciation will give you different picture of profit and loss account. So we have to be consistent in accounting policies. Next is materiality. Accounting believes each and every transaction, if it is materially, significantly going to affect your business, that has to be disclosed in the books of accounts, because whether it is 1 rupee or 1 crore rupees is material for some people. So it has to be recorded with giving due significance to that. Another is objectivity. Accountant has to be objective in his understanding that whatever expenditures, incomes, assets and liabilities has to be considered in an objective manner. Then only there will be real accounting can take place. Now, what are the distinguishing features between financial accounting and management accounting? Basically, it starts with purpose. Financial accounting is basically connected with writing of books of accounts, and management accounting, it talks about reporting. Moment financial accounting is ready with balance sheet, management accountant starts. Now let us see what are the reports are generated by the financial accounting and management accounting. Financial accounting talks about sales register, purchase register, cash book, bank book, ledger, journal. While management accounting talks about MIS, ratio analysis, budgeting, cash flow, fund flow. What are the standards for presentation? Normally, financial accounts are presented in a balance sheet format, profit and loss account format, while management accounting takes place by using various softwares of MIS. The reporting entity for financial accountant is basically the accountant himself, and for management accountant it is a finance manager, and they are reporting ultimately to the managing director of the company. What is the time period covered normally? Normally for financial accounts we cover for 12 months, and for management accountant is basically on month-to-month basis of continuous reporting. So what are the uses of this information? This information is used for various purposes. Financial accounting information used by management for internal working of the company, for auditor, for outsider who are going to read your accounts, and management accounting is for basically control, management control exercise. Now what is the role of accounting? Role of accounting is multiple. The basic role is it gives information about quantitative information, financial information, useful information and decision making. Thank you very much.